It just seems, I am no political expert at all, but it seems that he likes to use the shock factor initially. That brings people to the negotiating table, and then usually things calm down afterwards. But I'd like to welcome everybody to the 26th edition of Barnes Quarterly. This is a little bit unconventional from the way we usually do it. I have the good fortune to be in Nashville, Tennessee, beaming in, celebrating the birth of my first grandchild, a grandson. And everybody is doing well. Coincidentally, he happened to be born on the same day as my daughter. So that was a pretty great birthday present for her to get a new healthy baby. But all in the family are doing well, obviously adjusting to changes in their life. But we're very, very blessed to be able to celebrate that. Eddie, what do you got going on with your family these days?
Well, first, I just want to say Stan is currently searching for grandpa names. So if any of you have any suggestions, feel free to send them our way. Nothing major with my family. Everything's, pretty much carrying on as usual. We had a great holiday holiday stretch and went and saw some family. And now we are getting back into the swing of things, such as travel soccer and other activities that the kids keep us pretty busy for.
Well, very good. I may be asking you to refer to your notes from your child rearing, because my days of doing that were quite a few years ago. But I guess to put it in context too, we've just this past weekend, the country's been slammed by a pretty severe winter storm, and Nashville in particular took it pretty hard, but they seem to be thawing out now, so that's good. A couple of things that I'd like to mention. We're always trying to, I guess, expand and improve the services that we offer our clients. And I wanted to just highlight two initiatives that we've undertaken. And some of y'all have experienced the first one that I'm going to mention, and that is, artificial intelligence is all the rage right now, and it is the securities and investment industry is not exempt from that. But we are starting to use with our client meetings, whether they're virtual or in person, a note taker, which I've really been impressed with. It's called Jump. And basically what it does is records the content of the meeting and then organizes it into primary topics and lists to-dos for both the advisor and for the client. And it's a huge time saver, number one, but number two, what it does is it really allows us to focus on our conversations with our clients. And so, as opposed to focusing on trying to take notes during a meeting. And I think that's going to yield a lot of benefits for us over time. So if you have not experienced this yet, you will be. We obviously will notify you that you're being recorded and ask permission, but it really is a great tool for us, and we feel it's going to have a lot of benefits. The second thing that I wanted to mention is we've partnered with a firm called Total Family. And this is, I think, a little bit unique and unusual in that we're increasingly working with more and more, not just clients, but their clients' families and multi-generations. And you hear a lot about this in the industry right now. And what Total Family does is it provides a platform for us to work with our clients in doing some legacy planning. And this is not just limited to financial legacies, but it really delves into sort of family values and objectives that you want to pass along to your children and perhaps their children's children. And so we're still getting up to speed with this, with Total Family, but we will be, if anybody's interested in this, feel free to reach out to us and let us know that you'd be interested in participating. But I think this is, again, something different. And in client relationships, it's not just about the money. It's just not about the investment returns, while they are important. But we want to have a deeper relationship, and we feel like this is going to be a way that we can move that forward. Just want to welcome our Chief Investment Officer, Chris Zaccarelli, to the call. He is on with us each and every one of these podcasts for the 26 that we've done. And we find ourselves at the end of 2025 and the beginning of 2026. And so, Chris, if you would, I would like for you to just sort of sum up what we saw in the markets in 2025 and what we're looking forward to in 2026. I know things have started off very exciting, lots of volatility and lots of news items that have hit that are driving this. But let me just turn it over to you and educate us a little bit.
Well, thanks, Dan, and definitely congratulations to you and to your daughter. What a fantastic news. It's so great to welcome a new child into the world, and I'm sure you're an extremely proud grandpa, so that's fantastic for me, and I'm sure everyone, all your clients to hear about. So that is great news. It's already off to a great start for this year. But as far as the markets go, we're really in a situation where we've had a couple years of really strong markets, really bordering on 3 years. And so I think it's pretty natural to turn the corner from 2025 into 2026. I'm just wondering, how long this can last. And I think there's really two schools of thought. On the one hand, obviously, trees don't grow to the sky, and I don't think we can expect 20% returns year after year. And that's not something I think we are expecting. On the other hand, a lot of the good news or a lot of the good factors that have been pushing the economy forward have been helping the stock market and corporate profits. A lot of those trends are still in place. There's plenty of policy noise. I know you alluded to that, geopolitical concerns. There's any number of things to worry about. But as far as the underlying economy, still appears to be strong. The job market is still, with unemployment rates relatively low, GDP growth pretty high. So we've got a pretty strong backdrop for the economy. And so it's our expectation that, although the stock market is unlikely to have 20% returns in the S&P 500, we can still have a good year in the market across other sub-asset classes. So whether that's medium-sized companies, small companies, international companies, both in developed markets and emerging markets. And clearly, we've seen a lot in commodities and other asset classes besides just equities. So I do think the bull market continues. It just may broaden out a little bit. It may change its form a little. But I don't think just because we've had a couple good years in a row means that we need to get necessarily concerned about this year in particular.
Well, you touched on precious metals or commodities, and that's a question that's come up with several clients. Typically we think about, investing in gold and silver as a hedge, maybe against inflation or against volatility. And I know gold has hit record levels, as is silver, and that seems to be unwinding some right now. But does that fit into our clients' portfolios in some way?
So, I'd like to take that question maybe in two parts. And the first part is, commodities have always been pretty distinct from equities or stocks or bonds, and they have their own supply demand dynamic, and they've got their own trading cycles. And so, yes, generally speaking, something like a gold or also silver can be used in times as an inflation hedge. It can be used as a hedge against volatility. It also is an alternative store of value to just the dollar or euros or other currencies. So there's a lot of different uses that these metals have had, outside of all the other commodities, whether that's oil, energy, agriculture, et cetera. So generally speaking, we typically focus a lot on stocks and bonds, and that's what we've continued to do. However, we've always had some type of an allocation to commodities. And, last spring, right, or even a little bit earlier, last either February or March, depending on which portfolio you're in, we've added some funds to the lineup that already contain gold and some precious metals. So we were already thinking in terms of having a little bit of a hedging portfolio about a year ago. And a few years before that, we were focused a little bit more on energy because we were worried about inflation, and we were worried about what might happen from, the war in Ukraine, with Russia and Ukraine being, a large part of the commodity complex. So all of the client portfolios have some type of allocation to commodities, whether it's an explicit allocation you might see in terms of maybe energy pipelines, or whether it's inside of a fund. A lot of our international funds have historically had exposure to precious metals, or even some of our domestic funds, whether that's investing in materials companies or energy companies. So, the long answer is that we do have exposure to precious metals. But the second part was that, we're not trying to think of commodities as something that we would go into or out of in a large way just because you're seeing big booms and busts, because that's not how we invest.
Very good. Well, we do have a number of folks that have hit the retirement phase of their life, and, beginning of the year, they're kind of taking stock of how their portfolios are invested. They realize that they've had a couple of really good years in the stock market. And so, they frequently ask the question, well, are there things that we should be doing differently going into this year, since we have had a couple of good years in the stock market? And, there's been some talk that the investors are to some degree rotating out of the the large cap technology stocks and rotating into some of the fundamental industrials and basic industries and that type of thing. Are you making any significant moves and changing your allocations going into this year?
I wouldn't say we've been making significant moves in the sense that I don't think we're making large changes, but we've made a number of incremental changes. And so we started last year starting to get a little bit more involved in smaller companies, small cap stocks. At the beginning of this year, we've made some small moves into getting into medium-sized companies. So at the margins, we have been and we continue to slowly diversify a little bit away from the S&P 500, your large cap stock index, which has done very well for a number of years in a row. To be clear, we're still very much invested in the S&P 500. We have a lot of exposure to those large cap technology companies. And although it is very possible, and we may be seeing the beginning of a little bit of a rotation away from those companies, a little bit more towards other companies, I think it's important just to keep it in context. We would never completely exit a position in Amazon or Apple or Google or Microsoft. What we typically would do is potentially trim some of our winners and take some of those proceeds and then invest in other types of companies. And that's what we're doing either explicitly with our fund choices, or the underlying active managers that we're using, they're also doing that beneath the scenes as well. So all of that is happening, but I think it's important to realize that we're not making a wholesale change from what we used to be doing to what we're doing now. It's more of an incremental change, just taking advantage of the fact that some parts of the market are inexpensive, other parts of the market are expensive, and not using that as a reason to completely get into or out of something, but using that as a reason to potentially have a little bit less investments in one area and a little bit more in other areas. We're very much a believer in incremental and potentially improvements in the process, not necessarily, throwing the baby out with the bathwater and doing a wholesale change. So you could be seeing a lot of those changes either explicitly with a fund change that we're making, or a lot of times it's implicitly underneath the surface. You might see the same exact holdings in your account or in your portfolio, but the underlying stocks that those active managers that we're employing are also being rotated as well to some extent.
Okay, that's a great point. Well, it appears that we've got a president that likes to give us a healthy supply of headline risk if you're an investor, and whether it's government shutdowns or Greenland or tariffs or Iran or Venezuela, it seems like there's always something cropping up. And just curious to know how you navigate these events.
So that's very true. President Trump is different from so many other politicians and so many other presidents in so many different ways. I'm sure we could fill hours on all the differences. However, I think it is important to note that a lot of the market, as well as ourselves, have just had to adapt. And so you just have to understand that he is constantly available, constantly making his thoughts known. I think you have to, on the one hand, take with a grain of salt a lot of things he says. I think he does a lot of his thinking out loud or through tweets or socials. And I think a lot of the things he talks about potentially goals or things that he's interested in. So it's very important to separate those headline quotes or statements from what actually changes. And so that's been the hardest part, is saying, don't react to everything he's saying, because not everything he's saying may be something that he'll want consistently or something that he'll be able to achieve. On the other hand, you absolutely have to listen to what he's saying, because a lot of what he is suggesting or looking to do will actually happen. And so, clearly with Greenland or some of the other news stories, he did not invade Greenland. I don't know if he ever was actually going to do that, or if that was just something he was saying in order to get leverage. But on the other hand, he is making changes with the Federal Reserve. And so we now do have a new Federal Reserve president. He's known to be hawkish in the past. We'll see what he does going forward. So it's important to listen to what the president says. It's important to take into account, the information that's being given. But I think you'll see the stock markets have gotten used to a lot of these news stories and taken them in stride. And so again, I think it's about balance. I think it's about not overreacting. It's about listening to what's being said, but not necessarily acting on everything that's being said, or at least acting quickly. Sometimes it makes sense to just wait and see how things develop. And so that's really what we've done. We try to be patient. We've tried to not overreact to anything we've heard. But like I said, we have been making incremental changes to the portfolio, adjusting to how things are moving and how things are changing. And I think really that's the best way to neither ignore everything nor to listen to everything that you hear and react immediately.
Well, I mean, that's a good approach. It just seems, I am no political expert at all, but it seems that he likes to use the shock factor initially. That brings people to the negotiating table, and then usually things calm down afterwards. But just going back to my earlier point about hearing from our folks that are in the retirement phase of life, what would you tell them about what they should be doing with their portfolios? I mean, they're already into some degree of a routine where they may be taking income or trying to preserve assets. Any words of wisdom about moving forward?
Yeah, absolutely. I mean, I think, as usual, we'll speak in generalities, and each individual person will have their own specific circumstances. And that's the beauty of you and Eddie being able to speak with them directly and understanding what all of the nuances may be for their situation. But generally speaking, the more you're in the accumulation phase of your life, whether that's continuing to earn a paycheck and being saving for retirement, or whether that's having, a longer time horizon, a higher risk tolerance, or higher return objective. Generally speaking, if a larger portion of your portfolio is in the stock market or in risk assets, whether that's international or domestic, or whether that includes some commodities or even alternative investments from time to time, and then a lesser portion of your portfolio might be in things that are a little bit more stable, less volatile, less risky. And typically we think about, bonds. So generally speaking, stocks and bonds, equities, fixed income. But as we all know, there's lots of different types of stocks, lots of different types of bonds. And so generally speaking, when you're in that accumulation phase, it makes sense to either have a higher percentage of equities or a more aggressive approach to how you invest in the stock market, because you've got a lot longer time to accumulate. You've got a lot longer time to ride out the volatility. And hopefully you won't need the money for a long time that's to come. As you approach retirement, or as you start to take money out of your portfolio, and again, everyone's different in terms of how much money they're going to need from their portfolio, how much liquidity or how much of a distribution rate they're going to take. But generally speaking, you're going to want to go in the opposite direction. So for most people, as they have a shorter time horizon, potentially a lower risk tolerance, maybe higher liquidity needs, or they're looking to to live off of this portfolio as opposed to add to it. Generally speaking, you'll go more towards things with more stability. So we'll typically see people have, a higher percentage of fixed income or bonds in their portfolio. Again, every situation is different. This is a generality. It'll be great for them to speak with you and talk about, what makes the most sense, because we have different equity approaches, different fixed income approaches. But generally speaking, it may make sense to take that percentage down. So someone who's typically had 60 or 70% of their portfolio in stocks and the converse in bonds, maybe that comes down 10 or 20 percentage points, based on their specific situation and what they're trying to achieve.
Yeah, I guess tagging on to what Chris was saying, it's a good time to point out, some of the services that we have available for those of you that are in the accumulation phase or are in the distribution phase during retirement. We have internally a lot of tools and resources that we can use to help you guys plan through that process and figure out, what your best strategy might be, and whether it be us running scenarios through the e-money software that we have, or several of the other software tools that we have available. We can talk through your situation and figure out what might be the best course and strategy for you, during helping accomplish the goals that you're looking to accomplish. Chris, one of the things I wanted to ask too is just, figure out if you had any concerns or worries. We've had some news here recently with the deal with Canada and China. The U.S. has taken a little bit or moved away from the globalist strategy that we might have had in the past, and have started moving things a little more internal. And I think it's aggravated some of the countries that we've worked with in the past. And as they're looking elsewhere, I know China is making a push to sort of be the reserve currency of the world. Do you have any concerns that will come to fruition? And is that a short-term thing or something that's way out into the future? Where do you see that going?
So it's a great question. And I think we're really early on in a lot of these changes. What we've seen over the last year or two in terms of, the United States being, the head of NATO, sticking with a lot of our former allies, and really being, the head of kind of a globalist, global trading world order. Clearly there are some shifts. And so there are people who are talking about, massive changes underway. And I think if it's true that a lot of what we've done over the past, 75 to 80 years is dramatically changing, and it's going to be going in a different direction, time will tell. We'll know over the next, 10, 15, 20 years, if and when, there's been dramatic changes. It does seem like the way we speak with our allies, the way we conduct foreign policy is, significantly different in the Trump administration than what we've seen in the past. And so again, I think it's a combination of what, Stan and I were talking about before, where on the one hand, you absolutely need to listen to everything that's being said. You need to take it seriously. But on the other hand, it's important not to react too quickly. So on the one hand, I would say, clearly there's a desire from this administration, and keep in mind, Trump was elected by a large portion of the population to be a little bit more inward focused, to focus a little bit more on domestic policies, a little bit less on foreign affairs. And so I think the Trump administration is going about it in a way that is a little bit surprising to me, maybe not what people expected. But ultimately, I do think the administration is very much focused on changing the way that things have been done in the past. And so it's, again, too early to tell, what those major changes will be. But clearly, all of the countries that have relied on us for so long, have to adjust as well. And so I think, if we ended up with a situation, like we did with Cuba, and you've got, Russian missiles in Cuba, that's clearly unacceptable to the United States, regardless of who the president is. And if we ever got that far on the Canadian side, where there was Chinese missiles pointed at us, I'm sure we'd be under the same crisis. And the reason I use such a dramatic example is I don't think we're anywhere near that. I don't think we're headed down that road anytime soon. But it is important to think about, how far these things can go. For now, it just seems like it's economic treaties. I think, Donald Trump is trying to talk to the other countries, and on the one hand say, look, we've been potentially carrying a lot of weight, and so maybe it's time for all of you all to, do your fair share, whether that's funding NATO, or whether that's taking on a larger part of the economic process. Or, depending on your point of view, you could think, the U.S. is starting to take for granted the fact that we've been the reserve currency of the world. And while we've been the world's policeman, which is expensive, we've all benefited from having, global trade and global stability. And so I think there's a lot of arguments on both sides. But as an investor through this environment, I think what's important is that again, we as investors can't have all our eggs in one basket. We can't be 100% invested in the United States. We can't be 100% invested in the S&P 500 or the Mag 7. And that's something that we've never done. If anything, I think a lot of the time and care that we've taken with the portfolios, having exposures outside of technology, having investments in mid and small companies, having investments in international companies, and even various commodities, those types of diversification that we've done in the past hasn't always, bared fruit, meaning you could have been very concentrated and done even better than we've done. But as the world gets more complicated, as we see a lot more challenges and shifts and potentially crises, I think you can see the benefit of a lot of other parts of our portfolio continuing to do well, even if or when tech or some other parts of the portfolio slow down. So I think, if anything, this is more of an example of why it pays to not be as concentrated and have all your eggs in one basket. I will say it's worth watching closely, because as lots of countries around the world strike new agreements with China, clearly that's increasing China's importance. And so, this is going to be the story for years to come, where the United States and China are the two largest economies in the world. If they're not already the two largest militaries in the world, I'm sure China is trying very hard to catch up to the United States. So this is going to be an ongoing dynamic, and one that we just have to pay attention to, and we just have to accept it's not something we can change. And so, again, I think the way to do that is to just make sure that you're diversified. In this case, gold, I think, does play a very important part of diversifying the portfolio, in the sense that if the US dollar is slowly losing some of its reserve currency status, and I'd really caution a statement that the dollar is going to lose its reserve currency status anytime soon. But if it is something that's going to happen over the next couple of decades, having some diversifying effects in the portfolio in terms of international investments or precious metals is something that will really help us, and that's something that we're already invested in.
Well, I think on that note, that's probably a good place for us to wrap up, because I think we are at our time. But Chris, as always, thank you for your wisdom and insights, and really appreciate everybody tuning in. And from Nashville, Tennessee, we'll sign off.
Thank you, Chris.
Thanks, everybody.
Chris Zaccarelli are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.